Polls.
Thank you for having me.
Yeah. And we thank you for being here, Barnaby.
Welcome to the Deep Dive. Today, we're tackling something really crucial for mobile home park owners. The exit. That big financial decision. I mean, if you've run an MHP for years, you know the deal, right? You've handled everything, the tenants, the repairs, the late rent, the leaky roofs, you name it. You've poured sweat equity in, weathered the storms, but then comes selling time. And sometimes those traditional offers just, well, they feel a bit short. They don't always seem to recognize the legacy, the potential, what your park really deserves.
That's exactly it. That gap between what your park is really worth, maybe based on its potential, and what a buyer can actually get a bank loan for. That's a huge friction point we hear about constantly. And owners, well, they deserve more. An exit that's not just about the money, but is strategic, dignified, and importantly, tax efficient.
Which brings us right to our topic today, the solution we're going to unpack, really get into the weeds on, seller carry. You might know it as owner financing. And let's be clear, this isn't just, another way to sell. It's actually a pretty sophisticated financial move, a pivot, really. It's a chance for you, the seller, to potentially get a better price, control the deal, and even set up an income stream after you've sold.
Exactly. So our mission for this deep dive is to go beyond just defining seller carry. We want to dissect the mechanics, the real numbers, the tax stuff, the legal security, give you a complete strategic playbook, slowly, clearly, and in plain English.
Okay, let's unpack this. So to really get why seller carry can be so powerful, maybe we should first talk about the usual way things go, the traditional sale. What does that typically look like for an MHP owner, and what are the main headaches?
Yeah, the standard sale, well, it puts the seller in a pretty passive spot, almost vulnerable sometimes. The buyer goes to a commercial bank, right? And that bank kicks off a process that's all about their security, not necessarily the seller's convenience or timeline.
Meaning lots of waiting.
Months of waiting, usually. You've got deep due diligence. The bank wants environmental checks, phase 1 reports, maybe even phase 2. They want fresh appraisals, detailed rent rolls, tenant histories.
And they might have specific requirements about occupancy levels or park conditions that, maybe a smaller park or one needing some work just doesn't meet easily.
Precisely. And while all this is happening, this bureaucratic wheel is just slowly turning. The seller's basically stuck.
On hold. Can't really make big changes. Hard to look at other offers seriously. Just waiting for some faceless committee to decide.
That's it. The lender holds all the cards. And even if, after all those months of scrutiny, the deal does close, then comes the next hurdle.
The money part. You get the check, finally.
You get the check, yes. The sale price minus commissions, fees, all that. But because it's one big lump sum, the entire profit, the capital gain, well, it's all taxed in that single year.
Ouch. So you finally get through the sale, and boom, a potentially massive capital gains tax bill lands right on your doorstep, cuts right into your net proceeds.
It's the price of that quick cash.
Yep.
Immediate tax hit, zero control over the timing. Seller carry, though, it completely flips that script.
Okay, let's define that flip then. How does it work? If I'm the MHP owner, how do I become the bank?
Okay, the core idea is simple. You, the seller, provide the loan for part of the purchase price. Usually the difference between the buyer's down payment and the total sale price. So instead of the buyer going to, say, Wells Fargo, they're coming to you for that financing portion.
And there's paperwork, obviously, legal stuff.
Absolutely. The buyer signs a promissory note. That's their formal promise to pay you back. And crucially, that promise is secured by a legal instrument, usually a deed of trust or a mortgage filed against the park itself.
So if they don't pay, I have recourse against the prop.
Exactly. The park is the collateral.
Okay. And the payments, they come directly to me.
Directly to you, not some big institution.
Yeah.
You are holding the note. You are earning the interest. You basically become a private lender.
Which sounds like control.
Immense control. That's the fundamental shift. You help set the terms, the interest rate, the loan length, maybe it's 5 years, maybe 10, the payment schedule, interest only for a period. Fully amortizing. You negotiate that.
So I'm setting the rhythm of the deal for the next few years.
You are. It changes the whole end game. Instead of just cutting ties abruptly and dealing with that big tax hit, you're creating a planned, potentially income-generating transition out of ownership.
Okay, that control aspect is huge. But let's make it really concrete. People want to see the numbers, right?
Right.
How does this actually translate into cash flow for the seller? Let's use that example from the source material.
Right, let's put some numbers on it. Say the park's sale price is $800,000. And Often, with seller carry, you might be able to achieve a price closer to your asking price because the buyer isn't solely dependent on what a conservative bank appraisal might say.
Okay, $800,000 sale. And the buyer needs some skin in the game, obviously.
Definitely. You'd typically require a solid down payment. Let's say in this case, the buyer puts down $150,000. That shows commitment, and it reduces your immediate risk.
So $800K minus $150K, that leaves $650,000. That's the amount I, the seller, am financing. That's the note I hold.
Correct. $650,000 is the principal amount of the loan you're providing. Now, we need terms. What's realistic? Let's use the example's structure. 6% interest spread over 5 years.
6%. Okay.
And let's make an interest-only payments for those 5 years. That's a common structure. It keeps the buyer's payments lower initially while they maybe improve the park. Then, at the end of year 5, the entire $650,000 principal, the balloon payment, is due.
Okay, $660,000 note, 6% interest, 5 years interest only. So what does that mean for my pocket each month?
Let's calculate it. $650,000 times 6% annual interest. That's $39,000 per year in interest income.
$39,000 a year. Nice.
Now divide that by 12 months. That comes out to $3,250 every single month, starting basically 30 days after you close the deal.
Wow. Okay, so $3,250 a month, coming in like clockwork for 5 years. That's real passive income, secured by the park I already know inside and out. I've essentially turned my park equity into a monthly paycheck.
You've turned illiquid real estate equity into a high-yield secured income stream. And this is where we get into the really smart financial strategy, especially around taxes.
Right, the tax angle. You mentioned avoiding that big immediate hit from the lump sum payment in a traditional sale. How does seller carry help?
It allows you to use what the IRS calls the installment sale method. This is crucial.
Okay, installment sale. Break that down for us. How does it defer the tax?
In simple terms, you only pay capital gains tax each year on the profit portion of the money you actually receive that year. You don't pay tax on the entire $650 pay profit up front.
So I need to figure out how much profit is in each payment.
Exactly. You calculate your profit ratio, or gross profit percentage. Let's use the example numbers. Sale price, $800,000. Let's say your original cost basis in the park, what you paid, plus capital improvements you made, was $200,000.
Okay, base is $200, sale $800. So my total profit, my capital gain, is $600,000.
Right. Now, the profit ratio is your total profit, $600, divided by the total sale price, 800Ks. That's 0.75 or 75%.
So 75% of every dollar I receive from the sale is considered taxable profit.
Correct. The other 25% is considered return of your basis, which isn't taxed. So that first year, you receive the $150,000 down payment. 75% of that, or $112,500, is taxable gain for that year.
And the monthly payments, the $3,250.
Since those are interest only in our example, that $3,250 per month is ordinary income taxed at your regular rate. But the big capital gain chunk associated with its $650,000 principal, that's deferred.
Until the balloon payment in year 5.
Exactly. The bulk of that $600,000 profit isn't taxed until you receive that final $650,000 principal payment. You've spread that significant capital gains tax liability over 5 or 6 tax years instead of just one.
Which could mean staying in lower tax brackets each year, managing income better. Huge advantage. The money stays working for me longer before the tax man gets his full share.
That's the power of tax deferral. And it gives you years to plan for that eventual tax payment when the balloon comes due.
Makes sense. Now, what about that 6% interest rate? Is that actually good return these days? It seems okay, but...
It's actually quite competitive, especially for the level of security involved. Think about it. Where else could you reliably park $650,000 today and get a 6% return guaranteed by a physical income-producing asset like an MHP you know well?
Good point. CDs are certainly lower. Bonds? Maybe some riskier ones?
Right. Typical secure investments, CDs, many high-quality bonds, treasury yields are often significantly lower than 6% right now. So you're potentially earning a higher yield than you could get elsewhere with similar safety.
So this isn't a compromise I'm making. It's potentially a better investment for that capital than just sticking the cash in the bank or typical fixed income options.
That's exactly the perspective shift. You're not just selling your park. You're strategically reinvesting your equity into a high-yield secured private loan. You're pivoting.
Converting the park into my own private bond, essentially, secured by something I understand deeply.
Precisely. It's blending passive income, a strong yield, and smart tax management. That's why it's seen as such a sophisticated exit strategy, especially for long-term owners.
Okay, the benefits for the seller are becoming really clear. Higher potential price, controlled timeline, passive income, tax deferral, good yield. Sounds great for the seller. But usually when a deal seems that good for one side, you wonder about the other side. Is the buyer getting the short end of the stick here? Yet you hear this called a win-win. How does that work?
That's a fair question. And you're right, it genuinely can be a win-win. What's interesting is how the seller's control and flexibility directly address some of the biggest challenges buyers face, especially in the MHP space.
Before we get to the buyer wins, let's just double-click on the seller's security again. If I'm the bank, aren't I taking on default risk? What if the buyer stops paying that $3,250? Or what if the market crashes and they just walk away from the balloon payment? That's a worry.
It's a valid concern, but the structure is designed for security. Remember, that monthly payment, that balloon payment, it's all backed by the promissory note and, critically, the deed of trust or mortgage on the park itself.
So the park is the collateral if they default.
You have the legal right to foreclose and take the property back. And think about it. You, the seller, know that asset intimately. You know its condition, its tenants, its true operating potential.
And presumably the remaining loan amount, $650K in our example, is less than the park's actual value, especially since I already pocketed the $150K down payment.
Exactly. The buyer has significant equity invested right from the start. That $150K is their skin in the game. That's their first very powerful incentive not to default. They don't want to lose that.
And if they do default, is foreclosure messy?
Compared to a big bank navigating complex regulations, often a private seller foreclosure can be more streamlined depending on state law. Your recourse is clear. You get the asset back. An asset you understand, that likely has value well above the defaulted loan amount. So you have control over the money and the physical security.
Okay, that adds a layer of confidence. So recapping the seller's wins: price, timeline, secure income, tax deferral, solid collateral. Makes sense.
That's the seller side of the win. Now let's flip it. Why on earth would a buyer agree to this? Why pay potentially 6% interest to the seller when maybe, just maybe, they could find a bank loan for slightly less?
Yeah, seems like they'd always want the cheapest money possible.
It comes down to three key things for the buyer: speed, access, and the unique nature of MHPs as an asset class.
Meaning banks aren't always eager to lend on mobile home parks?
Sometimes, yes. Especially for smaller parks, older parks, or parks where the residents own the homes but lease the land lots. Banks can see these as non-standard or riskier compared to, say, an apartment building.
What makes them seem risky to a bank?
Well, often older infrastructure, private wells, septic systems can be a concern. Land leases add complexity. Sometimes the loan amount itself is just too small for a big commercial bank's appetite. It's not worth their underwriting effort for the return. This can lead to higher fees or just outright rejection.
So for certain types of parks, seller financing might not just be an option. It might be the best or maybe even the only viable financing option for a buyer to get the deal done.
Exactly. It opens doors. And even if bank financing is possible, seller carry offers incredible efficiency. Think about that 6 to 9 month slog dealing with the bank we talked about earlier.
The appraisals, the environmental reports, the committees.
All that red tape, gone. With seller carry, a buyer and seller can potentially close the deal in weeks, maybe 30, 45 days.
Wow, weeks versus potentially half a year or more. That's huge.
It's massive in the MHP world. It means the buyer gets their boots on the ground almost immediately. They can start implementing their business plan, maybe stabilizing operations, improving the property, adjusting rents where appropriate much, much sooner. Time is money, especially when you're trying to turn a property around. Seller carry buys them that precious time.
Okay, I see the trade-off now. The buyer is essentially paying a bit of a premium on the interest rate, maybe, in exchange for speed, simplicity, and the ability to bypass all that institutional friction.
Precisely. They gain the opportunity to get to work on the asset right away, and they value that convenience and speed enough to pay the seller a fair rate for providing the financing.
So it really does line up. The seller gets their price, income, and tax benefits. The buyer gets speed, access, and avoids bank hassles.
That's the harmony. It's financial engineering where both sides get what they need most. The seller's need for a smooth, profitable exit aligns perfectly with the buyer's need for efficient acquisition and operational control. It truly can be a win-win. Hashtag the spirit behind the structure and the legacy factor.
We've really dug into the numbers and the strategy, which is critical, but there's also a feeling, maybe a different spirit behind a seller carry deal compared to a traditional bank-driven sale. You mentioned the traditional sale can feel passive, maybe even adversarial sometimes.
It definitely can. A traditional negotiation often focuses on hammering out the lowest price, dealing with impersonal institutions. Seller carry, when done right, feels more like a collaboration. The source material had that nice analogy, comparing it to being courted to that $375 bottle of Chardonnay again, the one poured with care, not pressure.
Yeah.
It implies a certain respect, a focus on mutual benefit.
Yeah, it suggests the buyer isn't just trying to squeeze every last penny, but is actually considering the seller's needs for a graceful exit. It feels less like a transaction and more like an arrangement, an invitation to a continued, though passive, relationship.
That's a great way to put it. When a buyer proposes seller carry, especially early on, they're sending a strong message. They're saying, look, I respect what you've built here. I want to make this work for you too, not just for me. I understand you might want ongoing income, tax efficiency. Let's structure this together.
So instead of battling the seller down on price to satisfy a bank, they're offering partnership. They're offering passive income, speed, and avoiding those traditional headaches as a way to meet the seller's number.
Exactly. It acknowledges the seller's history and effort. And this ties directly into what we call the legacy factor, which can be incredibly important for long-term MHP owners.
You mean owners who've maybe had the park for decades, poured their life into it?
Precisely. For someone who's owned and operated a park for 20, 30, maybe even 40 years, that property isn't just an asset on a balance sheet. It's tied up with memories, maybe family history, community relationships. It's part of their life's work. Selling it isn't just a financial event. It could be deeply emotional.
And a quick, impersonal, bank-driven sale might feel like ripping off a bandage, a really abrupt end to that long chapter.
It can feel very transactional, very disconnected. Seller carry offers a sort of buffer, a transition period. It lets the owner step back without walking away completely all at once.
Oh, so?
Well, you close the sale, you get that significant down payment, so you realize a good chunk of equity.
Yeah.
But then that monthly check starts arriving.
Yeah.
That $3,250 in our example, every month for years potentially.
So there's still a tangible connection, a financial thread back to the park you created.
Exactly. It's a reminder, a continuing reward for the years of hard work you put in. You're still benefiting from your creation, even after you've handed over the day-to-day operations.
It smooths the transition. You're moving into retirement or on to the next thing, but you still have this secure income stream linked to your past success, secured by the asset itself.
And crucially, you help define the terms of that final chapter. You set the interest rate, the payment structure, the duration. You finished your ownership story on your terms, not the bank's terms, not dictated solely by the IRS's immediate tax demands.
It transforms you from just a seller into, well, a secured private financier, using your own assets equity in a really smart, controlled, and frankly dignified way.
It really is. It respects the history while maximizing the financial outcome. That combination of financial savvy and personal consideration is why it resonates so strongly, particularly with owners who have a deep connection to their parks. Hashtag tag outro.
Okay, we've covered a lot of ground here. The nuts and bolts, the dollars and cents, the security aspects, and even the sort of philosophy behind seller carry for mobile home park owners. Let's try to boil this down to the key takeaways for you, the listener, thinking about your own exit strategy.
I think the absolute first point is mindset. Don't think of seller carry as just a fallback if you can't get a cash offer. View it as a potentially superior financial tool. It changes your role from just passively receiving cash to actively becoming a secured lender.
Right. It's about transforming that sale, that liquidation of a physical asset, into the creation of a new asset, a high-yield secured note, an investment portfolio piece almost. And using that installment sale method gives you significant control over your tax destiny, optimizing income over years, which a lump sum just can't do.
And the second key takeaway is that win-win aspect we discussed. It's not just good for the seller. It works because it solves real problems for the buyer too, namely speed and access to financing in an asset class that banks can sometimes be wary of. That alignment is powerful.
So it really acts as a bridge between your legacy, all those years you put into the park, and the next owner's ambition to build on that foundation. It's a structured, profitable handover.
Absolutely. And as we wrap up this deep dive, I want to leave you with one final thought, something to connect this back to your broader investment thinking. We established that seller carry, structured properly, can offer excellent security backed by the real estate and a potentially high rate of return. We use 6% in our example, which often beats current yields on safe things like CDs or many bonds.
Right.
So here's the question to ponder. If you knew you could structure the sale of your next major asset, Maybe it's your MHP, maybe it's another piece of commercial property, so that it instantly converts into a secured, tax-advantaged financial instrument, paying you a higher yield than your current bond portfolio. Does that change how you think about the value of immediate lump sum quick cash? Does it make you reconsider the trade-off between that instant liquidity and a potentially more profitable, structured, guaranteed income stream that also respects the wealth you've already built?
That really reframes the goal, doesn't it? Moving from just cashing out to engineering income.
That shift in perspective, valuing predictable, high-yield cash flow, potentially over immediate cash, that's the mark of sophisticated financial thinking. And that, I think, is the ultimate power behind understanding and utilizing seller carry effectively.
A very powerful distinction indeed. Well, thank you for walking us through that so clearly, and thank you for joining us on this deep dive into the strategic exit for mobile home park owners. We hope this gives you the insights and confidence to navigate your own future transactions.